Stop wasting so much time on your crypto tax. If you are one of the brave people who likes to do their crypto tax on their own and not work with a professional firm like ours, then you probably are well aware of just how tedious and annoying it is to do your crypto taxes each year. So you're probably wondering, now that the tax deadline is over, what can I do next year, or this year rather, so that next year's taxes will be much easier. So today, for the brave souls out there who like to do this on their own, I'm going to outline 5 things that you can start doing right now to make next tax season much easier. Stay tuned. The first thing you should do is use a crypto tax software. I know there are some Excel warriors out there who are really passionate about the Excel sheets that you've built, but with the changing landscape and the new guidance, Revenue Procedure 2024-28, all of this is becoming more and more impossible to manage within Excel. You absolutely need to use a crypto tax software to help reconcile all of your trades, make sure that all wallets are being tracked accordingly, and the cost basis is being tracked at the wallet level rather than one universal pool. So we use Coinly primarily at our accounting firm. We use any and all crypto tax software. We have many clients that are on different various softwares, but Coinly is our preferred software. So if you aren't on a software yet, definitely use Coinly if you want to get started. We've linked that below. And load in all of your wallets, all of your exchanges that you've ever used, even if you no longer use them, and reconcile all of your transactions going all the way back to your very first trade. This is very, very important because ultimately the cost basis needs to be tracked from one wallet to another, all the way back to the start. And so if you have errors in your transaction history that have not been reconciled, they could be influencing current year transactions and the tax calculation behind them. So it's very important that all of your trades are accurately reconciled. But really, this is the first thing that you should do if you haven't done so already, is get loaded into a software. I can't emphasize enough just how important it is. It does most of the heavy lifting when it comes to the tax calculation. All you have to do is just make sure that the data within is complete and accurate, and then the software will take care of the rest. Now, once you've gotten yourself loaded into a tax software like Coinly and you've reconciled all your trades historically, now what you need to do is make sure that you are consistently updating the account list. So make sure that your account list, your wallets and exchanges is consistently updated. So the second thing is frequently update your new accounts and new wallets that you get as soon as you get them. So if you spin up a new phantom address, let's say, make sure you add that into your tax software immediately so that you can forget about it after that. Too many times we get clients where they come in, they say they have 4 wallets and that's it, and then they completely forget about some random wallets or random exchanges that they used, even if it was only for a few trades. Every piece is important. So as soon as you get a new wallet or start on a new exchange, just add that immediately into that tax software so that you can forget about it. You don't want to wait until the end of the year or next April when you're trying to do your taxes and having to think back, what was I doing back in March or May? And crawling your history of what was going on in your crypto trades. So just as soon as you get a new account or a new exchange, add it into the software and then you can forget about it. So with everything loaded into a tax software and the practice of consistently adding new wallets and new exchanges in, you are now set to make sure that you have all of the data included. So that's really the first thing, is just making sure that you have a process in place to ensure that all that data is included. The third thing is going to be documenting unique transactions. So things like gifts to friends or gifts from friends, or unique airdrops maybe, or rewards, or even just protocols that you're interacting with or smart contracts. Anything that's unique like that, you should have some sort of documentation behind it so that at the end of the year or come next April when you're doing your taxes, you have something to reference to remember what was going on. We see this all the time with our clients where they were gifting to friends or they were receiving gifts from friends, and we ask them what these transactions were, and they have to think back and remember all that was going on 2-3 years ago. So it's very important that you have some sort of documentation. It helps us out as accountants, and then obviously it would help you out too if you were doing this on your own. And then specifically the smart contracts and protocols, if you are working with an accountant or if you're working with us, this is also a huge help for our team, because being able to read your description of what's going on in that protocol is extremely helpful, and it helps save us time from having to go research it and figure out what is going on. The things that you want to include would be the types of tokens involved, what's the reward token, what's the native token that's being used, and then just the core functionality behind those protocols and contracts. That way we know what to look out for. So consistently document all of those unique transactions so that you have something to look back to when it comes tax time and you're reconciling all of your trades. Number 4, reconcile periodically. I know I just mentioned documenting all of those unique transactions so that at the end of the year or during tax season, you have something to reference when you're doing your reconciliation. If you want to make that process quicker, I would suggest reconciling more periodically. So either quarterly or even monthly, depending on your trade volume. Potentially even weekly if you are making hundreds to thousands of trades a week, which does happen sometimes. The more you reconcile, the less work there's going to be at tax season. And so what do I mean by reconcile? Basically, it's just you visiting your tax software and looking and reviewing all of the transactions that were made from the time you last reconciled through the current date and making sure that it's just complete and accurate. The software will most likely pick up all those transactions from the blockchain, via API. However, you have to make sure that they're being tagged correctly. So if it's a reward, it's tagged as a reward. If something was a transfer to and from a different wallet, it needs to be shown as a transfer, not separate deposits and withdrawals. So the software will most of the time get this correct, maybe 80 to 90% of the time. However, it's up to you to make sure you're covering that 10 to 20% that isn't necessarily picked up by the software. So the more frequently you reconcile, the less headache it's going to be at the end of the year or during tax season when you're doing that preparation. So I would suggest doing it at least quarterly, maybe monthly if you're a more frequent trader, or if you're extremely active, potentially even weekly. Now, the last thing you can do, it won't necessarily make the process easier, but it will help save you money on your crypto taxes, is to be on the lookout for tax loss harvesting opportunities throughout the year, but especially as we approach year end. What do I mean by this? Well, whenever you buy an asset, you get a cost basis, and if the price goes down, you have a tax loss. However, it's unrealized until you sell. So what many people do and strategic investors do is whenever they've made profits in a year, they are always looking out for other assets that might be at a loss that they could potentially sell out of in order to reduce or offset those profits that they made elsewhere. So you might even have capital gains from stocks or real estate that you're trying to offset. Look at your crypto portfolio periodically throughout the year, see if you can identify any assets that you're holding that are potentially underwater, and you can actually dispose of those to realize that loss and offset that capital gain from either other crypto or stocks or real estate or anything like that, any capital gains. So it's very important you're always on the lookout for that. With that said, there are some people that have mentioned the wash sale rule, the 30-day rule, if you will. And this is a key distinction to make, that it doesn't necessarily apply to crypto at this point in time. We know that the wash sale rule is defined as applying to securities, that you have to wait 30 days for securities. However, the IRS defines and taxes crypto as property, so it is not explicitly categorized as a security, and therefore the wash sale rule does not apply. Now, with that said, there is the economic substance doctrine you have to be aware of, so you can't necessarily just sell and rebuy immediately to harvest the loss. The IRS could potentially disallow that if they've determined you did that simply to avoid taxes. So really what you're doing is you're selling an asset because you are trying to get out of a potentially falling asset, and cut the bleeding, if you will, or stop the bleeding. And then if you decide you want to get back into that asset, you just don't necessarily need to wait a full 30 days like you would with stock. So that's the fifth thing, is just make sure that you are always looking out for tax loss harvesting opportunities. This is really something that every strategic investor does to make sure that they are not realizing large capital gains when they're simultaneously sitting on unrealized losses that they could utilize to reduce those gains. So to recap, the 5 things that you can do right now this year to ensure that next tax season goes a bit smoother is 1, use a crypto tax software. 2, update your account and wallet list frequently as you get them. 3, document unique transactions like gifts or smart contracts. 4, reconcile periodically, maybe quarterly or monthly. And then 5, stay alert to tax loss harvesting opportunities. By doing these 5 things, you will ensure that the process during tax season is very smooth. And then also that last one of tax loss harvesting opportunities, you'll ensure that you are not overpaying on your capital gains when you have unrealized losses that you can utilize. And lastly, if you want to avoid all of the hassle and not have to do any of those 5 steps, contact us today at CountonsheepYT.com. We've linked it below. You can book a free consultation. We are a crypto accounting firm, so we're a team of CPAs and accountants that specialize specifically in crypto tax preparation. So let us handle it for you. We do this professionally. We make sure your account is complete and accurate, but also very importantly, it's optimized so that you're paying the least amount possible. Like I said, book a free consultation using the link below. And then of course, we are going to be continually releasing new tax tips, crypto tax tips, and commentary on changing guidance from the IRS. So make sure to subscribe below for the latest updates.